Banks face default as credit losses and recession risk build. I'm your host, Steven Van Metre, and thanks for joining me today. And in a story we could have written about a month ago when we talked about how several U.S. banks were making fat profits trading Russian bonds, well, now those same banks are facing default. And after that, we're going to get into my comments about the Federal Reserve meeting today. All right, let's kick this off with the headline that Wall Street sees greater risk of default by major banks. And the cost to insure bonds of Goldman Sachs, Morgan Stanley, and Citigroup against default hit two-year highs on Monday on growing fears the U.S. Federal Reserve aggressive moves to tame inflation might tip the economy into a recession. Credit risks have worsened since the Ukraine crisis, and some big U.S. banks took a hit in their mainstay business, with capital market activity coming to a standstill and lending expected to remain lackluster, just as I've been talking about what happens when interest rates rise. Let's continue on, because that has prompted bondholders to continue hedging strategies to protect against potential defaults. The war in Ukraine and Western sanctions could knock more than 1% off global growth this year, if we're lucky, and add 2.5 percentage points to inflation, the OECD has said. JP Morgan Chase, Goldman Sachs, and Citigroup combined put aside $3.36 billion in credit loss reserves in the first quarter. That is a reversal from the past 12 months when lenders released billions in reserves after losses related to COVID-19 failed to materialize. Spreads on 5-year credit default swaps on Goldman Sachs closed higher, Morgan Stanley higher, and Citigroup higher at the highest level in 2 years. A credit default swap is a contractual agreement that lets buyers swap credit risk with sellers and thus insures bondholders against default. Spreads on 5-year CDS on JP Morgan, Wells Fargo, Bank of America also set to exceed near 2-year highs set in March, as again we see some of the major banks now facing default as, of course, the Fed looks to hike rates and slow credit growth. But the story's not over yet, because any short-term spike in CDS on U.S. banks is likely related to fears over Russian default. The correlation coefficient between Russia's 5-year CDS on sovereign debt and the bank CDS is between 50 and 60 basis points in the 5 months ended May this year, suggesting a strong positive correlation. A derivatives panel has ruled Wednesday that Russia could be in default after it failed to make payment on April 4th in U.S. dollars on 2 sovereign bonds, bringing a payout on billions of dollars in default insurance a step closer. And of course, we know that these risks, of course, when they hit the banking system, we saw what happened during the great financial crisis, and we don't know exactly how all of these loans intertwine and what real damage could be done to the U.S. financial system. But something that shouldn't go down with the U.S. financial system if it blows is your portfolio. The question is, can it handle another great financial crisis? If you're not sure, be sure to check out Portfolio Shield. I'll put a link up there in the corner and the description below, because there's more problems facing the banks as we talk about every week. And as lending demand slows, well, money flowing to the banks, well, that dries up too. Weekly mortgage demand rose for the first time since early March last week, but it won't last. A brief calm in the midst of rising interest rate storm boosted weekly mortgage demand ever so slightly last week, but it's unlikely to be the start of a new trend. Rates have already moved sharply higher this week. Total mortgage application volume rose a mere 2.5% for the week ending April 29th compared with the previous weeks, which have been down substantially. That is because mortgage rates took a slight step back and the spring housing market entered its historically busiest time. The few borrowers who would benefit from a refinance, which notably is increasingly less as rates go up, took their chance. Refinance applications rose 0.2% for the week, but were still 71% lower than a year ago. Since the refinance share of mortgage activity decreased to 33.9% of total applications from 35% the previous week, refinances made up a majority of mortgage activity last year. And not only a majority of activity, majority of how banks make money. Remember, they make money lending, and they need people to borrow money. And what we're seeing is demand at higher rates is falling, and that usually means rates are coming back down. Let's look at this with something we look at on a regular basis. Here's the mortgage refinance index, and we can see it hit a low point here around 2011, another one around 2017, and again here in 2019. And how does that translate? Well, you can go back and look and see. Here you have 2011 coming down. We see one in 2014, 2017, 2019. All of these indicators suggest that when things dry up for banks, Well, rates come down. And this is a challenging topic for people to understand because let's say that a car manufacturer produced a car that no one wanted and they flooded out the dealers' lots with it, and you went down to the car lot, maybe not to look at that car, but to look at a different one, and there's a bunch of them sitting there not moving, not selling. Now, what happens? Do they raise the price of them? No, the manufacturer usually cuts the price and maybe do a subsidized lease or interest rate. The dealer will cut. They want to move inventory because that's how businesses work. Well, when I want you to think about what is the bank's product? If a car manufacturer's product is a car and their sales network is a dealer, well, what is a bank's product? It's a loan, right? When you go into the bank, what do they want you to do? Or when you call them, hey, will we review your stuff to see if there's maybe something we can offer you? They want to lend you money. That's their product. The branches are their outlet, their dealer network. And if rates go too high, think about this. Just like the car dealer, if they can't move that vehicle, they have to cut the price. What happens with banks that can't move loans? Well, got to cut your price. In this case, your interest rate. Mortgage applications purchase home rose 4% for the week, but we're still down 11% year over year. Home buyers are now turning to more adjustable rate mortgages. That could get interesting, which offer a substantially lower interest rate, can be fixed rate up to 10 years. The ARM share of activity remained unchanged at 9.3% of total applications, but that is more than twice the share it was last year. The purchase market remains challenged by low levels of housing inventory, suggesting that new demand for mortgages will drop and rapid home price gains, as well as the affordability hit from higher mortgage rates that are forcing prospective buyers to factor in higher monthly payments. Rates resume their climb this week will make it harder for buyers to afford what few options there are on the market, with affordability near the record low and the supply of homes for sale is not increased enough to chill the competition. All that suggesting as mortgage applications are going to continue to drop at a time the Fed says, hey, we're going to hike and tighten financial conditions even more. So Fed released today their FOMC statement, and although the overall economic activity edged down in the first quarter, household spending and business fixed investment remained strong. Job gains have been robust in recent months, and the unemployment rate has declined substantially, and inflation has remained elevated, reflecting supply and demand imbalances. And those are the key words, supply and demand imbalances. Now, the Fed admitted that they cannot control supply chain inflation, which is a nice thing to hear them say, but they want to, and Fed Chair Powell was very clear in his press conference today, we will and want to bring demand down to the level of supply. And I want you to be thinking about that as we go through this, of what that means to stocks and bonds. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. The committee will seek to achieve its maximum employment and inflation at the rate of 2% over the longer run, with appropriate firming the stance of monetary policy. They are looking to raise and did raise the target range for the federal funds rate by 50 basis points or 0.5% to 0.75% to 1%, and anticipate that ongoing increases in target range will be appropriate, to the point where Powell said the committee is looking at further 50 basis point increases over the next several meetings. And when asked if 75 basis points was on the table, he said no, but he did say 50 basis points was talked about as an option for the next, again, several meetings, if you can only imagine. The committee also decided to begin reducing its holdings of Treasury and agency debt and agency mortgage-backed securities starting on June 1st, as described in the plan that we're going to look at momentarily. They're going to undertake operations to keep the federal funds rate at 3.25% to 1%. And they're going to maintain their overnight repurchase agreement operations. And what is a shock to me, that it was a soft form of QE that they could have gotten away with, but perhaps there's not enough collateral in the system, as our friend Jeff Snyder talks about, is continuing to conduct overnight reverse repurchase agreement operations with an offering rate of 0.8%, meaning they're going to raise the rate on money market accounts that they're paying, at least to the money market funds who are using the overnight reverse repo, which should boost money market rates and pull more money into the banking system. Again, the Fed's trying to slow demand down, and that's real key. Now, they're also looking at reducing their balance sheet, as we mentioned there, and here we see the plans for reducing the size of the Federal Reserve's balance sheet. The committee intends to do this starting June 1st with secured Treasury securities. The cap will be set at $30 billion a month, and after 3 months will increase to $60 billion a month. Decline in holdings of Treasury securities under this monthly cap will include coupon securities. Now, what do they mean by that? they mean any notes and bonds. So 2, 3, 5, 7, 10, 20, and 30s. But do keep in mind, if you're worried that they're targeting the long end of the curve, they're not, because majority of the Fed's balance sheet matures over the next 2 years. And that's not the 10s, 20s, or 30s. Those mature a lot further out, not even a concern. So the Fed's targeting the front end of the notes curve. So 2s, 3s, 5s, 7s, those are what they're referring to here. Now let's go on, because he says, if they don't have enough coupon maturities, then they're going to sell off treasury bills, or they're going to unwind their treasury bill securities to cover the gap. For agency debt and agency mortgage-backed securities, the cap will be initially set at $70.5 billion per month, and after 3 months will increase to $35 billion. So total is $47.5 billion a month starting next month, going to $95 billion after that. And so here's the story of where the Fed's going with this, is they are actually seeking to reduce demand. And then what did we talk about? Those two factors. Remember when we talk about treasury yields, what are those two factors? We talk about growth expectations and inflation expectations. Well, what about equities? Do they have the same numbers? Yeah, they want, those same two things, right? Growth expectations, inflation expectations. So let's look at what happens when the Fed pulls back demand, right? They're trying to reduce demand. What does that imply for growth expectations? Higher or lower? Right, lower makes perfect sense. So from bond perspective, that's good. From an equity perspective, that's bad, because they want to reduce growth expectations, which would then mean fewer corporate revenues, lower corporate profits. It all transmits out. Now, he was also clear he wanted to bring inflation down. So again, we look at future growth expectations, good for bonds, bad for equities. How about inflation expectations? He wants those to come down. That's his goal. Well, that's good for bonds, right? Because lower interest rates or lower inflation, it means lower interest rates, higher bond prices. How about for equities? Well, lower inflation expectations necessarily isn't that good, because it means less demand, potentially even tipping us into a recession. So now you have the whole picture here, is Powell is deliberately and methodically going to slow the economy down. If we don't get a recession, he's lucky. But just keep in mind, why does all of this end up being bond bullish and equity bearish? It's simple: growth and inflation expectations. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.